So we have covered up until now PGBP, and then we have covered most of the concepts of capital gain. Let's revise a few concepts first, then we will bring in new provisions. In PGBP, there was a concept of depreciation. What was this concept of block of assets? Can somebody tell?
It is the same set of, sorry, go ahead.
No, please, Shall, go ahead.
Actually, go ahead, you go ahead.
Okay, similar assets will be grouped together, and the whole sale or purchase will be considered at once, in the sense that if one of the assets of the block is sold and it is sold for a higher price than the combined value of the whole block, then the whole block will be treated as sold.
Perfect. Thank you. Let's talk about same percentage also. Let's talk about a little bit about 180 days concept, something related to 180 days. Can somebody remind me what was the provision?
Half October 3rd. So you take only half of the prescribed rate of depreciation.
What was the date that I talked about? The exact
October
date?
3rd.
October 3rd is the date. So if it is after October 3rd, what should we do? Is it full or half?
Half.
Perfect. Before it is full, right?
Yeah.
Okay. Let's discuss about the rates. There are 4 or 5 rates that I had told to remember. What was the rate for buildings?
40.
10%.
10% is the correct answer. 40% is for which asset? Can somebody remember?
Computers and books.
Computers and books.
Computers and books is the correct answer. Now let's talk about furnitures.
25%.
10%.
10% is the correct answer.
Buildings and furnitures are 10%, right?
Both are 10%. Somebody said 25%. 25% is for which asset?
I think intangible assets.
Intangible assets is the correct answer. Only 1% were left of discussion. Which one is left out?
Plant and machinery.
Plant and machinery, other category.
15.
What is the first?
15%.
15%, right? Everybody agrees?
Yeah.
Perfect. Now let's talk about a little bit about the enhanced or additional depreciation. Can somebody remind me of what is it and when does it apply?
Only if it's second hand, if it's bought second hand, there won't be any additional depreciation, and that depreciation will be 20% of the amount.
Okay.
And if it is bought
only
after
for 1
half,
year.
only for 1 year,
Only
and if
for
it is
1
bought after half the year, 10% this year and 10% the next.
Perfect. Only one exception is left out now.
If it's installed in office.
Perfect. Yes. So 2 exceptions were there. One, I mean, there are a lot more exceptions. Only 2 we are remembering, for example. So one is if it is a used one, whether in India or outside India, both are covered here. And another one is if it is used in the office. Perfect. Now, how do we calculate the depreciation? What is the first step that we do? Whenever we see a question, what is the first thing we do? We calculate one value. What is that value?
Written down value.
Closing written down value. Opening would be given,
Closing.
purchases would be given, so sell would be given, and we will be calculating the closing written down value. In the closing written down value, we'll be multiplying the rates as applicable, whichever is half, whichever is full, whichever is additional, and we'll multiply and calculate the depreciation. Perfect. Now let's quickly move to the concept of adding back. Let me ask you the question, you answer in just simple words. If the expense is disallowed as per income tax, will it be added back or will it be deducted?
Added back.
Perfect. If the income is related to another head other than profits in case of business and profession, will it be added back or will it be deducted?
Deducted.
Perfect. Everybody is clear about it? No questions on that, right? 2 major concepts there. Yes. Awesome. Now let's move on to partnership firm. Yeah, most important. So in the partnership firm, if there is an interest paid, how much is allowable interest to the partners?
15%.
12%.
Is the 12% the whole answer? Was there something else also apart from that?
If it is less, it will be the exact percent.
Yeah.
No, there was something else also. Try to remember. Something about partnership deed?
Or if he is a salaried, then he will not be eligible for interest.
No, not that. Not that. If what I'm saying is, oh my bad, the video is on. What is this?
It's Anvesha's videos on.
Okay, my
Oh,
bad.
I'm sorry. I pressed by mistake.
I saw my name on it. Okay. No problem. No
Okay.
problem. So, all right. So what I was saying was, if the interest rate given as per partnership deed is 11%, okay, partnership deed says 11%. Our income tax act says 12%, and suppose the partnership firm is paying 13%. How much interest is allowable here? Partnership deed says 11. Our income tax act, as we saw, is 12, and our actual payment is 13%. How much interest is payable?
12%.
Allowable. 12% is it?
Allowable is 12%.
No, that is 11%.
11.
That's what I was saying. There was another factor, that is the partnership deed. Partnership firm will not be allowed the interest rate beyond whatever is mentioned in the partnership deed. And see, there is a relation between those two. If the interest given in the partnership deed is more than 12%, then 12% is takes the precedence. However, it is less than 12%, then the rate given by the partnership deed takes the precedence. Does it make sense, everybody? If you remember, we had discussed that like this, right? So partnership deed and paying and then allowed and all that we discussed. Okay, now that is clear. Let's come to the major concept where we were discussing the salary, commission, remuneration, whatever name you call it. Salary is paid. There was a limit to that salary, how much will be allowable. What is that calculation? Can somebody repeat the whole thing? First of all, tell me what is the value that you have to calculate. There was a new term that was used. Let me give you a hint, some profit. Anybody?
Dheeraj, can you please repeat the question?
Yeah, so when there is a salary, remuneration, or commission, whatever name something is being paid to the partner, in that case, there was a limit that how much will be allowable. There was a limit for that. How do we calculate it? There was a particular calculation for it. In order to do that calculation, there was a value to be calculated, and that value was some profit. What
short
profit?
term and long term, you're saying where it was indented?
No, not that.
No, it is
it is book profit.
15, 1.5 lakh or 30%,
yes.
whichever is higher.
No, let's first of all make it clear that is book profit that we have to calculate first. Okay, how do we calculate book profit? Please, we'll go there, Sam. Once we are done with the book profit, then we'll go there. How do we calculate the book profit? So book profit is our allowable profit before salary. What did I say? Book profit is allowable profit before salary. Only salary is excluded. Everything else is properly done. Is that okay? Any questions? Okay, all right. Now let's get back to that calculation where it was some numbers was there. Shell was saying. Shell, please. First
1.5, first 3 lakhs.
Yes.
1.5%. Sorry, 15%.
No.
So 1.5 lakhs or 30%?
Yes. Or 90%.
90%.
or
We
90%,
check with
90%,
the-
1.5
is-
lakhs or 90%.
The balance?
and the remaining 60% of the balance.
Perfect. 60% is the correct answer. Yes. If your book profit is less than 3 lakhs, you will not go to the second category. Okay. That was, we practiced a lot of questions in that also. Okay. Now let's move on to our next calculations we did about capital gains. There were two types of capital assets, one short term, one long term. And there were two types of months I told. What were the months?
12 and 36. 12 for short term and 36 for long term.
No, that is incorrect. I mean, 12 and 36
for
you said
short term,
correct. No, when you said 12 for short term and 36 for long term, that is incorrect. Now, 12 for some other asset, 36 for some other asset.
Okay.
What was those
12
assets?
is for 12 is for that
Listed
bonds.
shares, listed
Listed,
shares
yeah.
is 12 months.
Yeah.
And asset,
And-
fixed
and,
asset.
And
Any other
everything
asset
else,
is
any other asset is
36 months.
Now let's talk about a little bit more. Now that Sami brought up the, when it is short term, when it is long term, can somebody answer based on those months?
Less than 12 months is short term
Yes.
for securities, listed
shares.
securities.
Yes.
Yeah, and about 12 months is long term. And the rate of interest is 15 and 20 for interest in tax.
Perfect. Perfect. That is awesome. All right. Now, very quickly, in the calculation between short term and long term, there was one difference. What was the difference?
Cost of acquisition.
Yeah, indexed cost of acquisition. So indexation was
Index-
different.
Indexation, sorry.
How do we calculate the indexed cost of acquisition?
By the CII
We-
table.
Yeah. What do we divide?
Multiplied by the latest CII,
Yes.
multiplied by the CII of sale,
Yeah.
divided by the CII of acquisition.
Perfect. That is absolutely correct. Now, what was the rate of tax on short term and long term?
15 and 20.
Perfect. So despite your basic exemption limits, even if you are an individual, you are falling under some other rate of tax, these particular incomes have specific tax rates assigned to them. So it doesn't matter which slab rate you are falling into. Okay, please do remember that. Okay, now there were two rates that we have to remember. 2001-2 is 100 CII. In the latest year, that is our assessment year for the exam is 21-22 is 301. Okay.
300. Okay.
Yeah, perfect.
I
Now,
thought 312.
No, 301. Okay. So we'll revise it a more number of times. You will remember it. Don't worry about that. These numbers and all, I'll revise it. But what happens is the calculation part I can't revise much, right? So you'll have to practice them. The multiplication, division, how to calculate, how do we calculate the capital gains? Like we deduct the improvement, we deduct the that thing, cost of acquisition, then the exemptions, and so on and so forth. Let's talk about one more critical concept. What if you have purchased the asset before base year? What happens then? How do you determine the cost of acquisition?
Before 2001, right?
Yeah.
So we will take 2001 base price, which is 100. Base CII.
I'm talking about the cost of acquisition only, not
Fair
the
market value we take. Fair market value.
Yeah, whichever is higher, right? Cost or fair market value, whichever is higher for you. So there can be a scenario where your fair market value is actually less than your cost price, cost in which you acquired, right? In that case, you will take the cost only. Whichever is higher, you will take. Make sense, everybody?
Yeah.
Okay. Yeah. Now, if there is a improvement that you have made to a particular asset in some year, then what is its treatment? What does it do in our calculations?
If it adds to the
Yeah, I'm
value of
saying
the
only.
asset.
I'm saying it is an improvement only in the first
Okay,
place.
okay. Then
Yeah.
we'll have to add it to the cost.
Perfect. It will be added to the cost. So ultimately deducted from the sale consideration, right?
Yeah.
What if the cost of improvement has been made before the base year?
we'll
Again, we take the fair
consider
market value, right, on that day.
Yeah.
So we ignore the
Considering that-
improvement, right? We ignore the improvement. We do not do anything about it. Everybody agrees to it? No questions there? We had discussed this, I think,
Yeah, no questions.
yesterday or today only. Oh, sorry, yesterday only. Okay. Now that that is clear, let's talk about what happens when a capital asset is converted into stock.
We take the value as on the date of transfer,
Yeah.
and then it is taken as a capital gain for the business, not
When
for
do you
the,
pay tax on
not
it?
when we get the money. That is when the
When we
property
actually
is sold.
sell the stock. When we actually sell the stock. You're right. Absolutely correct. No questions there? Yes, everybody? Okay. My further follow-up question is this. What about indexation? Indexation is allowed till the date of the sale or only till the year of conversion into stock?
Both will be done, right?
Okay.
For
let me-
income, it will be for income. For income it will be date of transfer, and I think for the stock we don't provide that provision.
Correct. So that means only till the year of conversion, isn't it?
Indexation not applicable for the stock or the business sale.
Yes, that is correct. That is absolutely correct. So what I meant to discuss was, please remember this. If our purchase has been done in 2010, here is the example for you, 2010, and you have converted that capital asset into stock in 2013.
Dheeraj, you're not sharing your screen.
No, it's okay. I'm telling, no, when I say here is the example, I'm telling the example. Now, 2010 is the year of purchase of the asset. 2013 is the year of conversion of the asset, and 2021 is the sell of the asset. In that case, for the purpose of capital gain, you will do indexation only till 2013, the year of conversion into stock. Is that clear? Any questions on that? Okay. Sell of depreciable asset. Sell of depreciable asset. Is it a short-term capital gain or long-term capital gain?
It should be long term, right? Depreciation comes into picture when asset is like getting depreciated as years passing on.
Any other opinion other than that?
36 months will be still applicable, right?
No, I had told this one. Remember, whenever the depreciable asset comes into picture, it is always short term.
Short term.
Yeah, whenever depreciable asset is there, you don't look at anything else. It is always short term only. Close your eyes, short term. That's all, nothing else. So that means automatically the indexation does not come into picture. No other complications. Simply deduct your closing WDB and you will get your short-term capital gain. Any questions? Okay. Let's carry on with our discussions. So we have a lot of number of provisions in exemptions, but I'm going to cover only two, because those two are the major ones, which in market also mostly people use, and in examination also I'm expecting hardly questions from these two only. And mind you, there can be a theory question on these two as well. These are very nice provisions, very favorite of people, teachers. So there can be a theory questions on these also. So there is this section called 54. There is another called 54 EC. This 54 is very famous because this is applicable to most of the individuals taking exemptions under capital gain. This is applicable when there is a residential house coming into picture. Now, if you have sold one residential house and you have purchased one residential house, you would get a benefit here. What I said was, if you have sold a residential house, and you have purchased a residential house, this section is beneficial for you. You can take benefit from here. How does it benefit? It actually gives you exemption for your capital gain. Whenever you sell one residential house, no, the money is bigger, the capital gain is bigger. Automatically on long-term capital gain by 20%, the tax becomes bigger. I mean, it goes into 10 lakhs, 20 lakhs, like that tax goes up to nowadays, even more for better properties. Now, this section is very useful in those scenarios. So what you do is you purchase another residential house, and whatever investment that you make for that particular new house is exempted here. Now, there is some limit of purchase. So now any person can say, 10 years back I had sold one property, today I'm purchasing, so give me exemption. That cannot be done. There has to be a, for administration purpose, there has to be a limit. So what they say is, if you are constructing a property, then from the date of the sale, within 3 years, you purchase another property. If you are purchasing another property, you either purchase 1 year before the sale or 2 years after the sale. I'll repeat that what I just said. There is a limit on the time limit. When do you purchase another residential house in order to claim benefit under this section 54? If you are constructing another residential house, you have to construct it within 3 next years. If you are purchasing another house, residential house, you have to purchase it 1 year before the sale or 2 years after the sale. Any questions, please? Okay. Suppose you purchased.
Quick check, Dheeraj. As
yeah.
you mentioned, he has to purchase before the sale, 2 years before the sale.
Yeah.
So he has to arrange the amount from different source, right? Not from the amount which has been accumulated by the sale of the residential house.
Yeah.
That's correct, right?
Yeah, that is correct.
Okay.
Source can be anything. Yeah. Source can be anything. Okay. They don't look at the source here.
No, you said, right, when SSC is going to sell the house, residential house, so he can either purchase the next asset before 2 years of sale or after 2 years of sale. So why we are considering before 2 years of sale? Because even he is not sure whether he is going to sell that property or not.
Yeah, very true. And not just that, I mean, often what happens is, if you are selling one property and purchasing another, you have to book the apartment. So especially for the people who are purchasing another apartment, they have to book, and the payment happens in tranches, right? And the payment happens a lot before the actual delivery of the property. So you will have to make the payment lot before year, 2 years, 3 years before the property is actually handed over to you. So that's why this thing comes into picture, that okay, fine, income tax department has given you 1 year before limit, at least 1 year before you make the investment, that is fine. So logic is not important for us. We have to just remember the provision, that's all. So now let's suppose I'll give you an example. Okay, suppose you have purchase, forget about the purchase. You have sold one asset on 12 March of 2021. You have sold the asset for, suppose, 30 lakhs. And purchase consideration, indexed cost of acquisition, basically, it's suppose I have already indexed it, I'm saying, suppose 25 lakhs. So your capital gain is coming to 5 lakhs. That's what I'm saying. Now, on 11th Feb 2020, you have made an investment of 4,50,000. On 11th February of 2020, you have made an investment of 4,50,000. How much of benefit will you able to take?
Will not get it because it is more than a year, right?
Absolutely
Prior.
correct. Absolutely correct. Now you will not be able to take. Now suppose I'll give you another example. I'll change the date. This is not 11th February, I'll make it 11th May. 4,50,000 is suppose 45 lakhs. 45 lakhs, but it is actually construction of a property. You have not purchased it, you have constructed the property. How much of benefit you can take from this section?
Is it not 3 years after?
Complete.
Sorry.
No, like we can see there is a provision, right? 3 years after, if it's construction, then it's like claimable full, right?
Mm-hmm.
Will not be able to take because it is only after sale we can take.
Absolutely correct. Absolutely
Right.
correct. So the 1 year before is only for purchase, not for construction. If the construction is being made, construction has to be done after, not before. Okay, let me now change it to purchase. Change it to purchase, and it was 4,50,000 earlier. Let me change that too. Now, how much of how do you say benefit you will get from this provision now? Now that you have purchased on 11th of May 2020. $4,50,000, right? So from the capital gain of 5 lakhs, 4,50,000 is exempted because of this section. You will pay tax only on 50,000. Make sense? Now, what if the investment was 5,50,000? What I said was, what if the investment is 5,50,000? What does happen now?
We'll get full 5 lakh as
Please remember, if
exemption.
it is 5,50,000, then it will be 5 lakhs only. So it will be limited to the capital gain amount that you have calculated. It will never be more than that. Make sense, guys? Yes? It will never be more than that. Okay. Now, let me introduce one more concept here. So what income tax department saw was, what people started doing, they just for the purpose of taking the benefit, okay, they purchased another property in order to pay less tax, and in a month or two sold that property also. Are you getting my point? People find loopholes here and there. So what they did was, they originally sold one residential house. Whatever capital gain they earned, in order to take the benefit, they purchased another residential house and took the benefit. But 2 months after that, they sold that property also. This is why income tax department, what they do is, they have a part of this section is, section 54 says, whatever new property, new residential house you are purchasing, you have to keep it for 3 years, minimum 3 years. What happens when you what happens when you sell that within 3 years? Your capital gain exempt value, whatever amount was exempted, it will be reduced from your cost of acquisition. Indirectly, what they're saying is, it will be added in your capital gain. Makes sense, right? Yes.
Yeah.
Let's take an example here. So here we have taken benefit of 5 lakhs. Yes. And our capital gain was 5 lakhs and 5 lakhs. This new property that we purchased for 5,50,000, okay, new property that we purchased for 5,50,000, going forward on 1st of May 2021, we sold it for 10 lakhs. We sold it for how much? 10 lakhs. Now it was, the cost of acquisition for this was how much? 5,50,000, right? Yes. But what the income tax department says is, this 5,50,000 will now become only 50,000. How? 5,50,000 minus 5 lakhs. Whatever amount you took the benefit the exemption value that he took, that will be reduced from your cost of acquisition. Indirectly, what they're saying is it will be added to your capital gain. If you look at it, your capital gain is increased to 9,50,000 now. Had this been not deducted, it would have been 4,50,000. So basically, they're penalizing you for selling the asset in between 3 years. Make sense? Yes. Any questions on this?
Yeah.
Okay. Now that this is clear, let's quickly practice one question and then we will move on to the other concepts. Give me 1 second. All right. So here is the question. Mr. Roy owned a residential house in Noida. In Noida, he has a house. Question is a residential house. It was acquired on 9/9/2011. 9/9/2011 for 30 lakhs. He sold it for 1,57 lakhs. 1,57 lakhs on which date? 7/1/2018. In 7/1/2018, he had sold. Is it a short-term capital asset? Is it a long-term capital asset?
Long term. More than
So
36
indexation has to be there, yes?
Yes.
Yeah, perfect. Now, Mr. Roy utilized the sale proceeds of the above property to acquire a residential house in Panchkula for 2,05 lakhs on 27/2018. So on 27/2018, he has purchased another property. Tell me, is this fulfilling the conditions of the provision? The exemption provision.
Yes, right. In both cases, purchasing.
Absolutely. So in 2018 itself, he has purchased. So within 2 years we have. So within a year also he has purchased. So that is absolutely fine. He is eligible for the exemption. Now let's, before moving forward with the question, because it will complicate a little bit, let's calculate the capital gain here for the first case. Okay. So how much is our consideration that we have received? 1,57 lakhs. Yes. 1,57 lakhs. Our cost of acquisition is 30 lakhs. We have to index it. Here are the indexation numbers given. Can somebody tell how much should we divide and how much should we multiply?
We should multiply it by 272.
Perfect.
And divide it by 184.
Yes, that is absolutely correct. And that comes to 44 lakhs 34,782. When we deduct it, it comes to 1,12,65,217. Okay. Now 1,12,65,217 is the capital gain coming in the first cell.
Yeah.
And our investment is how much? 2,05 lakhs. Definitely more than that. Will we get the exemption of 1,12,65,000 or 2,05 lakhs?